Hello, this is John again, Options Trading Pilot. Today we're going to spend a little time just on the basics. My business partner and I, Guillermo, we spent a lot of time on the details and on the technical sides, but this is going to be more of an introductory video for people that are brand new to maybe to the stock market, definitely new to options. So, and if you're a seasoned investor, you might like to watch this for a review. Well, let's get started. Again, we are optionstradingpilot.com. We have weekly videos, training videos, as well as market analysis where we think we're going for the week. We trade every day, all day long, and we post our trades in almost real time on our Discord services. So we provide one-on-one services to our clients where we can help them trade or look at specific situations. And then secondly, we post and train on Discord. And then we do some things here on YouTube, which are less specific to certain types of trades. These are more just trading ideas. So come out and see us, Options Trading Pilot. If you subscribe, you can subscribe to YouTube. Please do that. Like our channel, like the video. Come out for a free month of trial if you like, and see what we do over on Discord. So let's jump right into it. We are going to be looking at some what I'd call essential options education. Going to look at a regular option screen, bids, asks, calls and puts, kind of what I've done another video on called the wheel strategy, and exercise and assignment. And so we'll look right on that. And again, everything we're talking about is not a recommendation. It is more of a for entertainment purposes only, and for educational purposes. I think this empowers you to hopefully know how to trade, the basics, know your risk. Trading small and trading often is one of our things that we focus on quite a bit. So let's go into some of the basics. So open up one of my million screens here. So we're going to look here at, just pick any stock. We'll pick Apple. So it doesn't matter what platform you're on. We're using Tastyworks. You could use Fidelity, Schwab, and many others. So you can look at Apple stock. Right now it's trading at $145. It's down $5 for the day. It shows your bid and ask. The bid is usually ideally where you could sell it, and the ask is where you could buy it. And you can see here the difference usually is a penny. So it would be called a highly liquid market, highly liquid stock, when the bid ask is just a penny wide. So that there's other stocks that could be very thinly traded. There's not much volume. You can see the volume here for the day is almost 50 million. Some stocks trade very wide, so very harder to trade in and out of those and make money. So these are the different weeks. Each one of these has options. So a stock option gives you the right to buy or sell a put or a call at a certain time at a certain day and strike. So let's just pop one open. So we're looking at the July 15 calls. So these are the Apple July 15 calls on the left, right here, and puts on the right. If you don't have this screen in whatever service you use, it's definitely an option to have them side by side. A lot of places would default to just seeing calls and then seeing puts later. I like to see them all on one screen. So just a few things to think about with calls. If you're long a call, like this. I buy a 150 July call. What that allows me to do is if the stock's at 145 or if the stock's at 245, I still have the right to buy this stock at 150. In order to do that, I have to pay $4.65 per contract. That one contract in a stock option is worth 100 shares. So when you see this, just look at it in hundreds. So this is $465. So when you long a call, you purchase for a premium. This is the premium, and you have the right to buy Apple, in this case, through July 15 at 150. Now, if the stock goes down to say 120, there's no reason that you'd want to buy Apple at 150 when you could go out in the open market and buy it for 120. However, if your stock is now at 200, of course you want to buy it at 150. So that's one approach. The next approach is, and there's all types of risk involved with these. We're not really looking at risk just yet. Now, if I short a call, now this is, I'm selling this premium, but I'm obligated to sell it. So here the Apple is a July 15. I'm giving the right for someone to buy this from me. So I'm selling the 130 for 204. This, I want Apple to go up to 170, anything above 130 would be good, but the higher the better, because when I sell this, I want the stock to go up. I'm giving someone the right to buy this from me, so they want it to go down. So that's another strategy. Sorry, and this is on the put side. Now, if I sell a call up here, this would be like a 160 call. And let's say I'm selling it for $1.63, which is $163. We'll get into what all this other stuff in just a minute. What that gives me, I sell it at 164. I want the market to go down. Someone else that I'm selling it to wants the market to go up. So, and puts work a very similar way. So let me take this away. We'll get that jumping in a little bit. So what we have, again, we have calls. All this information here on the left are all calls. Everything related to the puts are all here. So further down, this row down the middle, this says this is 42 days until expiration. So if I close this down, you have June 3rd. So these strikes are expiring today, or this tranche. June 17, that's 14 days left of trading. We're looking at July 15. It has 42 days left to trade these options on this particular tranche. Now, this strike price here, that's what we talked about, and that's down the middle. So that's where you decide what you're going to buy or sell based on those prices. Some of these strikes, these are all 5-point wide. You might have some, I'll just pop in here. These are 1-point wide strikes. So it really doesn't matter too much. I do try to focus. I like strikes that are 1-point wide, 12, 11, 10, or 5-point wide, like we have with Apple. Here, these are 5-point wide. When they start getting 10-point wide, I would prefer to stay away from those because I like a little more flexibility. So we'll keep moving here. Again, this is the expiration date. So these are all the expiration dates here. And then when you open this up, you have the expiration date and then how many days till expiration. This shows you the volume here. And there's a lot of different columns you can put in here. But what this shows is, so for instance, for Apple, the expected move between now and July 15th is this brown line, which is about 135 to 160. So that's no surprise that most of your volume is going to be closer to at the money. And that term at the money means at the money. So the money is 146. So if you're trading at 145, that is considered an at the money trade. And out of the money trade would be something that's not trading close to the current stock price. So like 140 would be out of the money, 150 is out of the money, 160 is further out of the money. And in the money, since we're covering this, let's talk about it. In the money, something's trading at 146. If I buy a call, now that's considered in the money because it's actually under the trading value of the stock at this time. So this shows you the volume and the heavy volume, and this is just the volume for today. This shows you how much volume is trading in that stock today. I can show you, let's jump over to, well, I'll stay on Apple so you can see just a little bit more. Jumping over to Fidelity, it really doesn't matter what service you're looking at. They all pretty much look the same, or you can get them to look the same. So jumping over here on Fidelity, I have a few more columns. So again, it looks the same way. This shows the volume in this column for the day. This next column is open interest. So for the Apple, July 15, 150 calls, there was 7,389 contracts traded today. Open interest of how many traded today and before today is almost 20,000. And you could see here you have your bid and your ask. The change since yesterday, the last price from yesterday was 475. And you can see that you have your change for the day. This is the last price for just now, not yesterday, excuse me. But the change from yesterday is down $2.52. That makes sense because it's more volatile. Stock options are more volatile right at the money, and the market is down 5.3 points at the moment. So that makes sense. Now, of course, the farther you get out, the less volume there is. So someone's trading the 220, but it doesn't pay anything. Here's your bid and ask of 2 to 3 cents. Nobody's making that type of trade. So very likely someone's just closing out like we do very often at the end of a cycle or end of a period. You just close out your trade and you essentially are buying it back for no value if you're selling originally. So get back to this other screen. So in this case, your bid ask is 5 cents difference. That's pretty nice. I can show you others, but let's just keep it simple for this. If I'm buying this, I'm probably going to pay $4.75, which is the ask. If I'm selling, I pay $4.70, and that's the bid. Now, the reality in between is I'm going to be buying or selling at the midpoint if it's very flexible. So if this is $4.75 to $4.80, maybe I could get $4.77, buy or sell. Again, we have the delta. I like these screens because it shows me the delta, and this is somewhat really the probability of that strike getting hit or crossed by July 15th. So that's something I look at from a probability standpoint. So moving on here, we got the volume, we have delta. You can put a lot of other things in there. So let's look at just simple things. I can buy 100 shares of Apple right now for $146 per share. If I want to do 100 shares, which is one like a round lot, that would be $14,000, and I'd be long Apple at 146 and 100 delta because it's trading. That would be like long the stock. What if I don't have $14,600 that I want to put in 100 shares of Apple stock right now, or I don't want to, I just don't want to commit the capital. So what can I do instead? Well, if I feel like Apple is bullish and it's going to go up, but I don't want to put in $14,600, what I can do instead is say, well, I think that it's going to go up to, based on other analysis, we can look, because that's outside of the scope of this video. But you can do something simple, and I'm not saying you should do this. This would not be a general trade that I would do based on several parameters. This is an example, but this example works quite nicely. So it's trading at 146. You're getting time on your side, 42 days to expiration. July is out, 42 days. So I could buy Apple stock, 100 shares at 150, but in order to do that, I have to pay 4.75 or almost, let's say $500. So in this case, instead of putting up $14,000, I'm putting up $475. So right there, and you can see the buying power is really right at whatever it's acting that same way. So I'm buying the right to buy 100 shares at 150 through July 15. If the price goes up above 150, my break even is going to be the strike price, which is 150, plus the premium I paid, which is $4.80. So that would be 154.80. So let's say $155 to break even. So I wouldn't want to go in this trade unless I was bullish on Apple through July 15, and that it would be at least $155 because that's where I'm going to break even. Now, the nice thing is if Apple rallies to 180, now I bought it for 150, another $5, my break even is 155, but I'm buying it at 155, but I can go right out on the market and sell the option contract for 180. Well, that's pretty nice. Now, if I was long the stock at 146, you would have all that gain from 146 to 180, but you're buying the buying power, the amount of equity you're using to do that. You can do it, it's no problem. However, you can do it with stock options a little cheaper. So I buy it for 150. At 150 for $5, my break even is 155. It goes to 180. Now I don't actually have to ever take the stock. Now what I can do is the value of this 150 up to 180. So that's 30 points just for fun. It doesn't exactly work like this, but let's say that if I bought this at 150 for 475, it goes up 30 points. Let's say that 450 now might be worth, it's not this, but let's just say it would be worth about $22. So what you can do is I bought it for 470, it goes up to 180, that 470 is now worth, say, $22. So paid 5, sell it for 22, make the difference times 100 for the 100 shares. So you never actually take ownership of the stock. You just are buying and selling stock options in order to do that. So that's one way to do it. Now, let's go back and look at this trade. If I buy this at 160, or let's keep with the same example. I buy it at 475. So my max loss is $480 because that's what I paid, right? $4.80, $480. My max profit is infinity because in theory, I have an unlimited gain. Apple can go from 150 to a million. It's not going to. Why do I know that? Because it could, I suppose, but it's highly improbable. Your delta, this has this is on a 43 delta, but you can see even the market does not believe, based on statistics, math, probability, that even going to 170 has about an 8% chance. So 150 to 170, maybe 150 to 165, even that has a 13% chance. Right now, the probability of profit on this trade is only 30%, because you're having to go 155 plus the 5, 155 is your break even. And look at that, your delta is 31, your probability of profit is 30. So you're right in that ballpark of that type of trade. Now, what you can do is, well, I don't want to pay $500 for this right when I don't think the stock's going to go above 170. I mean, it says it right here, or even 165. So what we can do is put a top on it. So this now becomes a spread, and this is a debit, so you're paying 365, so it's the 475 minus the 91, or 90, let's say in this case, and that gives you, you're paying $380 to have this one contract. So now your odds of probability of profit are not much better, but you're paying less. So what you do is now your max loss is 380, because that's the difference between what you bought it for and what you're selling for. But your max profit is no longer infinity, it's $1,100. And how you get that is 165 minus 150, that's 15, minus the 3.8 gives you the 1.12. So you've capped your max gain, but you've also reduced your max loss. And you're doing this because of the probability. Why be down here? You're not going to, why cap it at 200 when it's a 1% chance of ever getting to 200? So these are the types of trades we do sometimes. I'll tell you with an IV rank, and this is implied volatility over 20 to 25. I would not be doing this type of trade because it's too expensive to buy here. I would rather be selling and then buying out here. And I can show you that in a minute. So what this strategy is called is a bull call spread. Bull because you want it to go up, call because you're on the call side of the screen, and it's a spread because you have two components, two pieces to it, a buy and a sell. So again, these are very simple. Anybody can do these with the right permissions from your brokerage. Buying close or at the money, selling out of the money, that's your prerogative. Now let's stay on the call side for just a minute. Let's say I switch this around and I say, well, I see where Apple's trading at 145, but the IV rank is 60. And look at this, the IV, which is a IV and the volatility gives you, is part of the Black-Scholes equation for how options are priced. It's bounced around, but look at this, from just the other day till now, it's gone up. So volatility looks like it's expanding. When volatility is over 20 or 25, and you can watch our other videos about this, I'd rather be selling premium than buying. So for instance, in this particular case, not a great example for ratios, but we'll look at it anyway. So now I'm going to be selling 42 days to expiration. I'm selling a call. And if you remember, if I'm selling a call, I want the price of the stock to go down, or at least not exceed 160. So right now I'm selling the right to somebody to buy this from me at 160. But to be careful, because if I'm naked, this is called a naked trade. So I get $161 in. Now this would be for an advanced traders, and most likely, if you don't have experience, your broker is not going to allow you to do this particular trade that I'm showing you right now. So I could sell the 160 for $162. That's my max profit. But my max loss is unlimited because Apple could go to $1 million. Highly unlikely. So I don't want to take that much risk, because what if it does go to 165? Then I'm starting to lose money, even in the small, even if it goes over that just a little. So what I would do instead, now you can see my max profit is my max gain was 162, but I've bought the insurance effectively, saying, well, if it goes above 170, I want to be protected, but I have to pay $49 for that. So on this leg, the 160 leg, I want the market to go down. On the 170 leg, I want the market to go up. You don't really look at them individually, you look at them in total. This whole trade is bearish. So because you're selling one closer to the money, buying one further out of the money, you look at the difference. So I got $162 on this one, but I had to buy the insurance. And this is risk of loss insurance for 50 cents, 49 cents. And so now my max profit on this is $113, but my max loss, and that's the amount that I collected. This is called a bear call spread. So it's bearish, so it's a bear. It's on the call side again, and it's a spread because there's two pieces, so a bear call spread. So my max loss, though, you can see is no longer infinity, and how I get that is 170 minus 160, which is 10. Subtract out the credit received. That difference is $887 is my max loss. This generally is not a good ratio. This is like, say, 1 to 8. So I generally don't like that trade. I would not take that trade. You'd have to go into something a little riskier. Your max profit, say, is 200. Your max loss is 800. That ratio is about 1 to 4. I like to be 1 to 3, 1 to 3.5. 1 to 4 is about as much as I want to do. And you can see that now your delta is 30 on this one. So that gives you, it's a higher probability that this will be executed against you. What's nice is the probability of profit is 74%. So this is a decent trade. And if you think that this Apple's going down, this would be probably a trade you would be interested in looking at. So that is quickly a view of Apple and what we could do with a bull put spread. I'm sorry, a bear call spread and a bull call spread. And I think I'll stop in here for now. For call spreads, we can do something similar on another video for put spreads, and then we can get into other activity. But I think once you get the call idea down, and then the bearish and bullish call spreads, it's easy to kind of flip it over and do the same type of thing on the put side. But let's stop here. That gives you a good example of what looks like on the call side. Thank you for this. If you like it, subscribe. If you have questions, you want to see other videos, let us know in the comments. Again, John, Options Trading Pilot. Thanks.